Welcome. I thought what I'd do today is take you through the spreadsheet I've built to value a company. There's nothing magical about the spreadsheet, and I believe anybody can build a spreadsheet like that. And if you wanted to and spent enough time, you could probably build a much better spreadsheet than the one I've built. But given that most of us face time constraints, including you, I thought rather than reinvent the wheel, I'd at least give you the basic spreadsheet, and you can then adapt it. So let me go through cell by cell what the spreadsheet does and what you will need to input. First, if you notice at the bottom, the spreadsheet is a series of worksheets, right? Start with the input sheet. That's where the bulk of your work is going to be done. In fact, almost all of the numbers you need to input are going to be highlighted in yellow. And this is a valuation I did of Boeing in late March of 2020. And this spreadsheet includes the adaptations I've built in for what I think this crisis that we're in is going to bring to the company. So first I enter the date of my valuation. Why do I do this? You'd be amazed how many companies I value, and then I go back and look at the valuation and say, when did I do this valuation? So if nothing else, it's a reminder to myself about the point in time that you're valuing the company, because let's face it, the value for Boeing I'd have in 2021 or 2022 are going to reflect very different stories and numbers for Boeing. The second, of course, is you enter the name of your company. If you keep moving down, it asks for your country of incorporation, and that's a pull-down menu. If you look at the menu, it pretty much lists every country in the world that your company could be in. It might not include North Korea, but if your company is in North Korea, I seriously doubt that you're going to be able to get the financials to value the company. In this case, I've picked the United States. Then it asks for a sector. Again, this is a pull-down menu. Pick the sector that's closest to your company's primary business. In the case of Boeing, that's aerospace defense. So if your company is in 4 different businesses, pick your biggest business and pick the sector. Later on, when we get to betas, I'll give you a way to bring in the other businesses you're in. And I do it twice, once for US, once for global, because I'll report the averages for that sector across both US companies and global companies. Then we get to revenues. Revenues are, of course, the top line in the financials, and I ask you for revenues in this year. What do I mean by this year? The most recent 12 months. In the case of Boeing, I got lucky. Why? Because the most recent annual report had just come out. So the most recent financials, I'm going to let the plane pass by. The most recent financials were through December of 2019. It's the annual report, so I entered that number, 76.559 billion. Then I asked you for your last 10K. In this case, for Boeing, that is 2018. And because I had full 2019 and 2018 numbers, I entered one. Let me give you a case where this might not be what you would do. Let's suppose you look at your company, their most recent annual report has not come out. The most recent data that you have is through September of 2019. So it's a trailing 12-month data through September of 2019. You'd enter the revenues there, and then you'd enter the revenues from 2018, the full calendar year, in the next one. But because there are only 9 months separating the two, you'd enter 0.75. So if you're using a trailing 12 months through September, you'd enter 0.75 there. And you can see as you go through this year, you will actually have to adjust for this, reflecting when you're doing the valuation. So that's your revenue line item. The next item I ask for is operating income. Keep on the income statement, and if you keep coming down, I'm not asking for net income. I want operating income before taxes. Enter the number for the most recent 12 months and for the previous year. In the case of Boeing, that's 2019 and 2018. And it's 1 year again for Boeing because they're both full years. Then interest expenses in both years. Enter the gross interest expenses. If you have trouble finding it, check the footnotes. If you still have trouble finding it, maybe your company has no debt and you might be looking for something that cannot be found. So if your company has very little or no debt and there's no interest, just let it go and move on. Then I ask you for book value of equity. This is the total shareholders' equity, including retained earnings, paid in capital, all that stuff in the balance sheet. And when I looked it up for Boeing, the number I got for the shareholders' equity is negative. You're saying, how can that be? Hey, shareholders' equity reflects losses you've made, buybacks you've made. It can be negative. In fact, it's negative for 1 in 10 US companies. I enter the negative number. And that's from December 2019. There's a number from December 2018. Then I get to total debt. Now I'm looking at the debt on the balance sheet. And for some of your companies, this debt for 2019 also includes lease debt, and you have a choice to make. You can either count the lease debt that accountants have given for this company and move on and say, look, I trust the accountants. Or you can say, I still don't trust the accountants. I'm going to go with my estimate of the lease debt. If it's the former, if you're going to trust the accountants, count all of the debt you see in the balance sheet. Interest-bearing debt, short-term interest-bearing debt, long-term interest-bearing debt, and lease debt, if you want to count that lease debt. Show that for this year and last year. Okay. And that basically will give you the debt and equity numbers for the most recent year. Let's keep going. Then I ask you, do you have R&D expenses to capitalize? For most of your companies, there might be no R&D expenses. But if your company has R&D expenses, here's what you do. You enter yes, and then you have to go to the spreadsheet and give me some data on how to convert the R&D. So first I ask you, how many years will it take you to amortize or get the R&D to commercial usage? Don't spend too much time on this. For most companies, I would use 2 or 3 years and move on. For Boeing, it's going to be a little longer because between the time they do R&D and it shows up in their aircraft, I would say 5 years. If you're doing a pharmaceutical company, I would do 10. So make your choices 3, 5, or 10. Don't spend too much time trying to figure out what that exact number is. Then I ask you for the R&D expenses in the most recent year. So those are Boeing's R&D expenses for 2019. And because I'm going to take 5 years to amortize, I have to enter the R&D expenses for the last 5 years. So that's 2018, 2017, 2016, 15, and 14. This is why it's an advantage to have that S&P Capital IQ access if you have it, because then you can look it up. But even if you don't, you should be able to find this data with 2 or 3 annual reports put together. So that's the R&D capitalized. Remember I asked you about the leases and I said, do you trust accountants? And if you trust accountants and the leases have already been converted as debt, to debt, you can count it as debt. With Boeing, I did decide to go with the trust of accountants, and I'll explain why I'm okay with it. I included that as total debt. But if I did not trust accountants, I could have said yes to this, made sure I didn't include lease debt in my total debt, then go to the lease converter and enter the numbers for Boeing. And these are the actual numbers for Boeing. Those are the lease expenses for the most operating lease expense. So this is just operating leases. Capital leases have always been debt. So just operating leases. Enter the operating lease expense for the most recent year. These are their lease commitments for the next 5 years. So this comes out of the footnotes of the balance sheet. And there's the lease debt beyond year 5. And I will convert that debt using Boeing's pre-tax cost of debt. I'll come and explain where I got that pre-tax cost of debt in a moment, but I use that 4% pre-tax cost of debt. The present value that I get is my estimate of the debt value of leases, $1.335 billion. You know what, I actually did this and I checked the numbers in Boeing's balance sheet. Boeing's lease debt was about $1.4 billion in the balance sheet. You know what? The numbers are close enough that I said, I might as well trust the accountants in this one. So I'm going to change this back to no because, as I said, I've already treated lease debt as part of my total debt. But if you want to not count lease debt, then this is your chance to bring lease debt in. Incidentally, if you have a company like Netflix and you decide to treat content commitments as debt, say yes and enter those content commitments in those cells where you saw lease commitments. So basically add the content commitments to them. Then I ask you for cash and marketable securities. So if you go to the balance sheet, this will be often the first item on the balance sheet. So this is basically the amount of cash that Boeing had at the end of 2019, $10 billion, and the cash they had at the end of the previous year. If your company has cross holdings in other companies and 5%, 10% minority holdings in other companies, and you have a value for that, this is where you enter the value. So if you have a company with a lot of cross holdings, enter the cross holdings for the most recent year and the previous year. In some cases, all you might have is book value. Beggars can't be choosers. If you can convert the book value to market value, great, go ahead. If you have minority interests, you're saying, what are minority interests? Remember, if you own 60% of another company, that number is consolidated and you're using the consolidated financials. This is your chance to tell me what the value of those minority interests are. So here's what's going to happen. The minority holdings, I'm going to add on to your DCF value. The minority interests, I'm going to subtract out. And that's why I need those numbers. We're almost there. I ask you for number of shares outstanding. Now, many balance sheets will have a share count, but they'll have a diluted primary. Use the primary share count if you're getting it from a balance sheet. My advice actually is go to Yahoo Finance or Google Finance and check the latest share count for your company, because share counts can change over time. In the case of Boeing, that number was about 566 million and the stock price is below it. Here's a very good quick check to run. Multiply your stock price by the share count you have. The market cap you get for your company should be roughly what you see as the market cap reported in Yahoo Finance or Google Finance or the Wall Street Journal for your company. If it's not, it's possible that you're missing an entire class of shares, because some companies have two classes of shares and sometimes they give you only one class in the balance sheet. So just make sure your share count times share price roughly approximates the current market cap. Then I ask you for a tax rate. Again, don't think through this too much. For some of your companies, you might have an effective tax rate for last year and you might say, look, I'm going to stay with that effective tax rate. In the case of Boeing, the effective tax rate last year was 0. Why? Because they were losing money. So I decided to enter the effective tax rate of 25%. I'll take care of the fact that they're losing money and carry forward the NOLs. So the 25% here I'm just using because I think that they're going to converge very quickly on a global tax rate given their business model. And their marginal tax rate is the marginal tax rate for the US. Incidentally, if you go to the country equity risk premium worksheet that's built into the same spreadsheet, I give you the tax rate by country and you can enter that as your marginal tax rate. So those are the numbers for your company, and they're in a sense base case numbers. They come from your financials. Now is when you got to leave your comfort zone, because now I'm going to ask you for numbers that are your estimates. So first you'll notice two rows in red. These are the rows I've introduced into the spreadsheet post-coronavirus, and here's why. Most cases I ask you, what's your revenue growth going to be for the next 5 years? But let's face it, 2020 is going to be a break in that model. Even the very best of companies are going to have trouble in 2020. So I ask you what your growth rate is going to be for 2020. So next year basically is 2020. So don't think of it as 2021, it's the next 12 months. And I've essentially assumed a 10% drop in revenue. So you're saying only 10%? Take a look at Boeing's revenues in 2019 versus 2018. It's already down a lot, almost 30%. What happened? The 737 MAX happened. Boeing's revenues used to be more than $100 billion for the last 5 years. 2019 is already a drop. So 10% drop is already a decline on a low number. Boeing was expecting to bounce back this year. I don't think that's going to happen. I also assume they would continue to lose money. They lost money last year, which is a break again from their traditional profitable model. I think they're going to continue to lose money. I put in a minus 5% margin. After that, I think they're going to recover. And here's the story I'm telling for Boeing. Remember, we talked about stories. There are only two aircraft manufacturers in the world, Boeing and Airbus. And I think there are going to be only two aircraft manufacturers after this crisis is over, and Boeing is going to be one of them. And I think airlines around the world are going to need to buy aircraft. So there's going to be a recovery back, not to some glory days, but again to what they used to have in 2015 or 2016 or 2017. In fact, one thing I do when I enter this revenue growth is I go to the output to check to see what revenues I'm giving Boeing over time. And notice that if I give them a 15% growth rate, the revenues do climb to $120 billion by year 5. $120 billion in revenues would bring them back close to where they were 4 years ago. So this is not an outlandish number, and that revenue that I'm focusing on, $170 billion in year 10, is clearly within their reach, given the fact that this is a duopoly. There are only two big players, and the airline business will still need aircraft. So let me go back to the page, my target margin of 15%. So one thing I would suggest is enter a growth rate there, then go check your revenues, ask yourself, are you comfortable with those revenues? So that's your first big number, is that revenue growth between years 2 to 5, because that's going to drive your end story for the company. Then I ask you, what are your margins going to look like once all of this is said and done? Boeing's in a lot of trouble and it's in for a lot more pain. But eventually I think Boeing's margins are going to move back towards some steady state. What will that steady state look like? The margin for our aerospace companies globally, this is basically Boeing and Airbus pretty much consolidated, is 9, and a bunch of smaller players as well, is about 9.8%. I'm going to assume that over time that the margins are going to move back towards this, and this is a margin that Boeing used to have before their troubles. So it's not again a reach for Boeing to go back to 9.86% margins, and I'm going to assume it's going to happen fairly quickly once the pain is behind them. So that's an assumption. The story here is they're going to have a year of really bad pain, and then the airlines are going to have to start to order aircraft to make up for these lost years, and the margins are going to converge back. Maybe I'm being over optimistic. Then I ask you for sales to capital. This tells me how much you're going to reinvest in future years. In the case of Boeing, what I'm doing is I'm looking at their own history. And in their own history is for every dollar of invested capital, they get about $3.80 in revenues. I also give you other choices. I could have set it to industry averages, which would have been lower. But here's where we talked about adapting the model. When you enter the sales to capital, I use it as my sales to capital ratio every year. And here's how it works out. Every year, I take my change in revenue from year, and I divide by 3.8 to get my reinvestment. In fact, what happens in year one is because my revenues drop, I actually get a negative reinvestment, which means cash coming in. So what Boeing is going to do in 2020, I think, is all that R&D and capital expenditure it planned, it's going to cut back to almost zero, because it has to survive. So that's what that positive cash flow is coming from, is cutting back on R&D and capex that they'd originally planned. But that 3.8 becomes my basis for every year for the next 10 years. Let's say that you don't like that assumption. Let's say in the case of your company, you think they have excess capacity for the next 5 years and they don't have to reinvest very much. You know how this is going to show up? You're going to have a really high sales to capital ratio for the next 5 years. Why? Because they already have excess capacity. But once the capacity is done, you want to bring the sales to capital ratio down. Here's how you can do it. Add an extra cell, and this is the adaptation you got to do. So for the first 5 years, you might set the sales to capital ratio at 10. You don't need much investment. But after year 5, you set it at 3.8. And if you do that, go into the spreadsheet, and for the first 5 years, make your sales to capital ratio. Sales to capital is below here. Make your sales to capital ratio, set it equal to your input in that first cell, which will be 10. And starting in year 6, set it to what it should be after year 5. It's a very simple way you can adapt the spreadsheet to reflect the fact that you have different sales to capital ratios. If you have no idea what I'm talking about, check the Tesla do-it-yourself valuation spreadsheet from earlier this semester, because that's exactly how I adapted the spreadsheet. We're almost there. Let's keep going. I ask you for a risk-free rate. Remember, that's got to be in the same currency you're doing the valuation. The case of Boeing, that is in US dollars, I entered the 10-year T-bond rate as of the day that I did this valuation. Don't get fancy here and say the rate looks low, I'll fix it, just enter today's rate. The cost of capital, you can either compute it yourself. Maybe you've done the dirty work of computing it yourself. And if you compute it yourself, make sure you update your equity risk premiums to reflect the much higher premiums we have. But if you want me to do it, there is actually a cost of capital worksheet for you to use. Again, remember, the green cells are cells that I pulled out of your inputs already. The yellow cells are the cells you input. So you can ask me to compute your beta, and there I give you a couple of choices. I can say, is it a single business? In the case of Boeing, I did describe it as being just in the aerospace defense business. And if you say single business, I do the dirty work for you. I go look up the beta for that business. There's a lookup table. Basically, it's built into the spreadsheet, and I come up with the beta. If you're in multiple businesses, then you have to enter the businesses. And again, if you want to see the choices, you can enter multiple business US, multiple business global. But if you enter it as a multiple business, then enter the businesses therein. And again, each of these is a pull down menu. Enter the businesses, enter the revenues they get from each business, and I'll do the rest of the dirty work of looking up the beta, estimating the value, and coming up with the beta. I also give you a choice of entering this as a direct input if you want. If you've already computed a beta for your company and you trust it, enter that beta. For the risk premium, I ask you what regions of the world, how do you want me to compute risk premium? Here again, I give you choices. Do you want to directly estimate the equity risk premium, which if you've done the work, you can. You can base it entirely on country of incorporation. Do this only if your company gets its revenues entirely from that country too. You can give me the countries in which your company operates. For some companies, they will tell you where in the US and Mexico. If those are the two countries, enter the countries you operate in this call. And these are both pull down menus, how much revenues you get from each, or regions if your company does not break down revenues by country. Incidentally, at the bottom of each of these, I've added 2 extra yellow cells. This is because some companies are sloppy. For instance, let's take Boeing. Boeing gives me operating regions of the world. They tell you how much they get in Africa, Asia, Australia, Asia outside of China, North America, Western Europe, but then they have a China row separately, which is not included the rest of Asia. So I enter China myself and I pull up the equity risk premium. So these last two rows are for you to fill in loose ends if your company is not that good about breaking down things. I know that sounds messy, but basically if you do that, I'll compute your risk premium. For the debt, I take your book value of debt and your interest expense that you've given, and if you want me to, I will estimate a market value of debt, but only if you give me a maturity for the debt. If you don't have a maturity, just enter 0 in the maturity and I will make your book value of debt equal to your market value. For the cost of debt, you can either input it directly. In the case of Boeing, I inputted it directly because I was able to observe Boeing bonds and what they were trading at. Or you can give me an actual rating for your company, if your company has an actual rating. So I could have used this for Boeing because Boeing does have an actual rating now of BBB. Or I could have done a synthetic rating where if my company did not have a bond or a rating, I could use it. And if you do synthetic rating, I will again do the dirty work. It's already built in. You don't have to enter any numbers. But if you do synthetic rating, tell me whether it's a big company or a small company, because the kinds of ratings I will attach to it will vary. So in the case of Boeing, it's a direct input 4%. The rest gets computed, and as you can see, the nice thing about letting the spreadsheet compute the cost of capital is every time you change the risk-free rate, the cost of capital will automatically get adjusted. Just as a what if, let me show you. Let's assume that I wake up tomorrow and the T-bond rate is up to 3%. You see, cost of capital goes up with it. So the nice thing about not directly entering numbers is later on, and there will be a later on, 2 weeks or 4 weeks from now, when you update this valuation, you update the risk-free rate, everything's going to get updated. Then I ask you whether you have options outstanding. Not all companies have employee options outstanding, so if you can't find any, just let it go. If your company has options outstanding, it will be in the footnotes to your company's balance sheet. Check the footnotes and you should see the total number of options outstanding. Companies will often break options outstanding into vested and total options. I always use the total options. I don't look at just the vested ones. Enter the number of options. Note a caution. Through all of this, keep your units constant. In the case of Boeing, I entered everything in millions, including the dollar values, the number of shares, the number of options. If you want to enter everything in thousands, make sure your share count is also in thousands. If you want to enter everything in actual dollars, do so, but I would caution you against doing that. You don't want to have eight digits to enter. So I prefer to actually work in millions or at worst thousands, but make sure everything is in the same unit. So if your share, one very good test to run is check your option count against your share count. If your option count is 10 times your share count, something is wrong. Go check the units to make sure you're entering everything in the same units. The same footnotes that give you the option count should also give you the strike price of these options and the average maturity. Enter those. And if you want to look up the standard deviation Boeing, you can look it up. But right now, if you want to enter 30 or 40%, standard deviations is sky high right now. Just enter 40% and move on. It's not going to make a heck of a difference to your overall valuation. So those are your basic inputs, and then I ask you questions about default assumptions. In this valuation, I've done a lot of things to keep you from getting yourself into trouble. And now I'm going to allow yourself to get into trouble if you want to. But I think you're ready. I think you know enough about valuation. I hope I've done my job. That you should be able to go and change these defaults if you feel like it. So the first default is I actually default your cost of capital to be I think I might have changed this default, but it's your risk-free rate plus your risk premium. So the default I think is set to, let me see, I can actually fix it while I'm here. The default is actually set to whatever your risk-free rate is plus your equity risk premium. If you feel that you don't want to go with that default, say, look, I want to override this assumption, say yes, and enter your default. What would you enter as the number? Remember I talked about a histogram of cost of capital, and the median cost of capital for a company is about, right now, about 7.5% to 8%. I've entered that as my target for Boeing. So I've overridden my inputs and entered 7.5%. Then I ask you, because in my default I assume that when you get to stable growth, I do what McKinsey does. Assume your return on capital is equal to the cost of capital. If your company has very strong barriers to entry, and I think Boeing does, I'm going to override that assumption and enter a return on capital that is higher than my steady state cost of capital. So those aircraft capabilities that Boeing has built up are not going to disappear after year 10. So again, I've overridden the default. Now comes a very important variable that you might want to think seriously about before you ride right over it. When you do a discounted cash flow valuation, you're assuming your company will survive and be a going concern. Now this virus is going to put that assumption at risk for a lot of companies. In the case of Boeing, I think there's a real chance that Boeing will run into serious enough trouble that even if it survives, it might need a bailout so big that my equity will get wiped out. So this is both to capture the chance my company will actually go under or that my equity will get wiped out by a bailout. I've said, yes, I want to override the assumption that my company will be a going concern and put in a 20% chance of failure. That is a huge shift from what I'd have put 6 weeks ago. That's the other effect that the coronavirus has had, is in addition to my revenues dropping and my margins staying negative for next year, I now have a 20% chance of failure. Leave the next one at its default if you want. Basically ask you, well, what do you want me to set it to? Do you want me to set it to book value? Do you want to set it half of? So, I've set it as a function of what the value of the business is. But I've said, look, if I actually get into trouble, my value is going to be only 50% of my estimated value, which is actually going to be less than my debt. So my equity really is going to be worth nothing in this 20% scenario. The next question is about your tax rate. Let's say you're at a company where your effective tax rate is only 10%. Why? They're very clever at deferring taxes. Right? Now this is okay. This is in my value in the default. What I do is I move your effective tax rates towards your marginal tax rate. Maybe you have a company that's so clever that it can keep its effective tax rate at 5% forever. If you want me to, so if you want that default of the tax rate moving to your marginal tax rate being overridden, just say yes to this, and I will just leave your tax rate at the effective tax rate. If you have NOLs carried over, then you enter yes to this number. In the case of Boeing, I think they used their NOLs against previous year's income. So I said no, but if you have an NOL, then enter the NOL here. I've also assumed your risk-free rate will stay the same in perpetuity. Now, if you look at that 0.85%, you're saying, no way. I think that's going to go up. Let's say you believe your risk-free rate is going to jump to 2%. 2% sounds like a huge number now relative to 0.85%. You can override my default that the risk-free rate stays the same and enter it. And what that will allow, remember I capped the growth rate at your risk-free rate. So right now if you leave it at 0.85%, your growth rate in perpetuity will be 0.85% as well. So if you feel not comfortable with that, or if your risk-free rate is negative, you're doing a euro valuation, this is your chance to change it and set the risk-free rate to a different number. I'll adjust your risk-free rate, which will push up your cost of capital in stable growth, but I'll also adjust your growth rate in perpetuity. The effects are going to kind of offset each other. You can do a what if trial and error to see how much of a difference it makes. It's not going to make that much of a difference. Finally, I have set the growth rate at the risk-free rate in perpetuity. If you want to change that, let's say you have a company that you think will peak in year 10. You're doing Zoom. You think it's a great technology, but after 10 years, you think the technology is just going to go away. You can enter a negative growth rate or -5%, -10%. You remember I said I'm going to give you rope to hang yourself? You might even set a growth rate above your risk-free rate, above your cost of capital. Then don't blame me if your terminal value is negative. So don't do crazy things here. Finally, the last 3 rows you can ignore because this is from pre-2018 when US companies used to have cash that was trapped overseas that could not come back. Apple, for instance, had $140 billion in cash. And if it was brought back to the US, they had to pay a differential tax rate. And so this was an allowance for that. So if any of you have cash remittances that are trapped somewhere, you can use this to kind of capture how much of a discount you need to apply in cash. That's pretty much it. The rest, as I said, gets done. So the valuation output here is what I would focus on. Look at not just your growth rate, look at your dollar revenues in year 10. Ask yourself, am I comfortable with those dollar revenues? In the case of Boeing, I'm giving them $170 billion. That's not outlandish. This is a big market. There are only 2 players. I'm giving them 9.6% margins. Ask yourself, are you comfortable with that as well? In fact, focus on the revenues and margins in year 10 because that's what your company is going to look like in steady state. Notice my cost of capital starts high, over time declines to my cost of capital. Remember that I said one of the tests you can run as to whether you're building a company that you can live with in the long term is what kind of return on capital you're giving them in perpetuity. I'm actually allowing Boeing's returns to climb over time to almost 27% because they have so much excess capacity built in because of the 737 MAX being shut down. But after year 10, I do bring that number down to 10%. But here's what you should watch for. If that number is 270%, then you're probably reinvesting too little. Use a lower sales to capital ratio. If that number is 2.7%, you're probably reinvesting too much. Use a higher sales to capital ratio. Use that as a feedback loop. So I've got everything I need. So the spreadsheet will do the calculations, but remember the spreadsheet is not valuing the company. It's just taking whatever you gave it in the input sheet and reflecting it value. Basically, because I have put a 20% chance of failure, notice that my value for operating assets, I'm knocking off 10 billion for the failure effect, because if I have failure, my equity is worth either nothing or very little. I add cash because I did not have any cross holdings, there's nothing there. And because I didn't have any consolidation, I have no minority interest, but that's where you'll see a cross holdings and minority interest show up. Boeing had no options. If you had options, my option value worksheet that's right down here would have computed the value of the options, netted it out. I divide by the number of shares, I get a value per share. Incidentally, one of the things I've built in here is a stories to number, which basically takes the numbers you have and allows you to tell me what the story is. So in the case of Boeing, I can actually so it basically takes all the numbers. So when you first open this, you might see the Boeing story in there. Don't leave that story in there. Make it your company's story. And with each input, tell me why you get the input that you do. So basically with Boeing, my story for revenue growth is a duopoly growing market. Okay. This is industry margins, also close to historical for the margins. So with each one, next to each assumption, I can list my story, and at the top I can actually tell the story. It gives me a way of summarizing my valuation, so now I'm not printing off pages and pages of a spreadsheet. So take advantage of it if you can, and build something similar if you're building your own spreadsheet. Yeah. So there's nothing magical that happens in the spreadsheet. I've just tried to take the things we've talked about. One of the things I've tried to do here is the country equity risk premiums that are built into the spreadsheet, reflect what's happened in the last 6 weeks. In what way? My starting premium for the US is 6.8%. Incidentally, that's already dropped to 6.5% just in the last 4 days, right? It's a moving target. And my equity risk premiums across countries, I've actually doubled the default spreads I was attaching countries, because that's what's happened in both the CDS market and the sovereign government bond market. Much higher equity risk premium, much higher add-ons for every country. My equity risk premiums are much higher. I will update this table with a little more finesse next Tuesday, so just continue the evaluation. You can just cut and paste what I do next Tuesday into the spreadsheet, and your valuation will automatically get updated. Okay. Final piece of suggestion, I am not trying to push you into using my spreadsheet. I'm perfectly okay with you building your spreadsheets. Couple of suggestions if you do build your own spreadsheet. First, less is more. If you have an investment banking spreadsheet, please don't send it in to me. I will lose patience very quickly, because investment banking spreadsheets have all kinds of inconsistencies built into them. I can't even call them valuations. Most of them are disguised pricing. So if you're going to build your own spreadsheet, do it yourself. Less is more. Don't have too many line items in your valuation. Keep your input page separate from your output page. Don't hard code numbers into your valuation. That way you'll have a chance to revisit your valuation. Keep it simple, check for consistency, and I'm perfectly okay with you building your own spreadsheet or adapting mine or just using mine. The end game here is for you to value a company, not become a spreadsheet ninja. This went a little longer than I expected, but I hope you find it useful.